This is Alan Bush with ADMIS. In the stock index futures, we are seeing lower prices this morning. We did have a series of economic reports which on balance did come in weaker than expected. We did have the Philadelphia Fed Index coming in at a negative 12.5. The guess was a positive 1. We had jobless claims coming in up 20,000. So follow through weakness after yesterday's sharp declines in stock index futures. Today, of course, yesterday we did see a one-day reversal on some of the equity charts. Also, we had the heaviest volume of the year on yesterday's decline, so that's very significant from a technical point of view. It should be viewed as a sign of weakness for the stock index futures market. We are also seeing insiders selling at a rate of 12 to 1 versus their buys, so that has to be viewed as an additional indication of pressure likely for stock index futures. Over in the currencies, seeing the euro currency under pressure this morning. We did have an economic report showing the services and manufacturing industries contracting again, so a lot of pressure in the eurozone. We did see some support coming into the yen. This looks mainly like short covering. I think this is a trend that will probably not last longer term. I think the yen will head lower, and I think we'll see pressure developing probably through the balance of this year for the Japanese yen. I think the same situation is likely for the British pound, even though the pound a little bit higher after making a new low for the move in the overnight trade. Gains in the pound will probably not follow through, so I would look for pressure developing in the pound as well. In the credit markets, we are seeing some flight to quality buying coming in, with the Treasury futures market gaining almost a full point today. This appears to be directly linked to pressure in stock index futures. The overriding influence over the last day or so in all of these financial markets is the Fed and their more hawkish tone to their more recent Fed minutes that were released yesterday. So apparently a lot of dissension on the Fed as far as how long to continue the quantitative easing plan is likely to remain a very important influence over the near term, in fact probably for the balance of this year. So once again, Treasuries, we believe, are in a new bear market, only subject to temporary flight to quality gains, which should be viewed as selling opportunities. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
Let me double check. I don't know if they're looking at 3 o'clock. It's one or the other. It could be changed.